We're honored to be joined today by Abhinav Munshi. Abhinav is the founder and managing partner of Razor Capital, a GCC-based cross-border alternative investment platform bridging capital and opportunity across the GCC India corridor. With over 20 years of experience investing across emerging markets, Abhinav has built and scaled institutional investment platforms working with leading Middle Eastern investors. His experience spans the full private capital spectrum, from early stage venture to late stage growth and buyouts, across sectors including healthcare, education, aerospace, food and agriculture, to financial services, technology, oil and gas, and real estate. An aerospace engineer by training, Abhinav holds an MSc in aeronautics and astronautics from Stanford University and a BSc in aerospace and economics, awarded with the highest of Georgia Institute of Technology. Abhinav, thank you very much for being with us here today. Let's get straight into it.
Thank you, guys. Look forward to it.
Yeah, thank you again for making the time for this. As Ari said, we'll just get straight into it. So obviously you trained as an aerospace engineer at Stanford and Georgia Tech, but you still entered you started your career in alternative investments. So what sort of drew you initially from that world of engineering STEM into alternative investments? And what was that training like, and how did that help when you sort of joined as an investor?
Yeah. So look, I think for me, my background has always been deeply technical. My dad was a professor in IIT in Mumbai. I grew up on campus. So going into engineering was sort of almost a given. And, obviously I enjoyed the sciences, especially physics and math. And so, that just made a lot of sense for me. But early on in life, I was in boarding school. I had an interesting experience where a group of us set up a small business on campus. This was in, small sort of trading enterprise, which then, in the context of that school, etc., grew into almost like a quasi banking exercise, which was super interesting. And it taught me a lot about markets, about monopolies, about regulation, because we ultimately got shut down by the school authorities. So that was something that I think my early memory was something that just fascinated me. And so ever since, I've always been interested, in that business world, in markets and so on. But I never really studied it. I didn't really have people around me who were from that world. So it was sort of passive. And then when I was in engineering school, I had to make a choice at one point in my career to whether I go down the research path or, do something else. And something happened, which was essentially 9/11, while I was just about to graduate from undergrad. And what that did was it shut down aerospace research, jobs, etc., were all sort of linked to government funding, security clearances, etc. And so I realized that there was always going to be this glass ceiling, this sort of inherent sort of disadvantage. And so that was a point where I was like, I had this other interest, and I decided, I want to sort of pivot. And so while I did go to grad school after graduation, it was very clear to me at that point when I was at Stanford that I was going to move out of the sort of hardcore engineering space into something more commercial. Honestly, I had no idea, right? So the first thing that came to mind was banking or consulting. And so I sort of started thinking in those terms. And then I sort of by accident, by chance, met a small group of entrepreneurs in the Middle East when I was on a holiday, who were setting up what was supposed to be the first private equity fund in the Middle East. And that sounded fascinating. Emerging markets sounded fascinating. This was 2002, 2003. And the whole EM, sort of wave was just starting to pick up. And that's the time I visited Dubai. And Dubai was a fascinating place because it was tiny, but you could feel an incredible amount of energy. Things were starting to happen. It was also close to home, which was India. And so, a combination of all of those things, I decided to make the plunge. I've got to tell you now, I had no idea what I was getting myself into. I had no idea what it actually meant, but it sounded cool. And so I decided to take that route. And then, the one thing led to another from there. But that was really the sort of genesis of my move into the investing world.
Very nice. And when you sort of entered the investing world, fresh as a graduate, you have a very, I guess, different way of looking at the world as you would now, which we'll get into later. What was, I guess, the aspects of the job that turned out to be very different than what you'd expected?
Yeah, no, that's a great question. Look, I think I've got to say again, I had no idea what it actually meant, right? It was a very superficial sort of view of whether it was investment banking or private equity. And to the point where I hadn't actually done any accounting, for example, right, in school, etc. So I had zero knowledge of accounting and so on, financial modeling, whatever. And I remember my interview was with my first boss, and one of the questions he asked me was, "So do you understand what leverage means?" Right? Because obviously, LBOs, etc., were a core part of what private equity was. And what I remember telling him is like, I have no idea what it means in the investing context, but I understand what leverage means in the physics context. And interestingly, and luckily for me, I think he was like, well, you know what? The principles are not that different. So you'll figure it out. Right. Um, I think my initial impressions when I came into the investing world was there were two parts of it, I think. One was that, you had this impression that it's a very technical thing, right? It's about accounting and it's about modeling and it's about numbers, etc. And the other thing was that, you start with this idea that there is a right answer, right? This is right, this is wrong. And if you make the right answer, the investments will be successful. You'll make good investments, right? And if you pick the wrong answers or the wrong things, and I think what I realized over time, right, um, and very quickly on the technical side is that, especially private markets are not technical, right? They are, especially when you're getting into private equity situations, operating businesses, the value is actually in the execution. It's in the operations, right? And while all the technical aspects of it, from our perspective as investors, are necessary, they're certainly not sufficient, and they're not the biggest part of how value creation happens. And I think that was a very early learning. And I think we will talk a little bit about, a couple of early mistakes that I made, and what that sort of showed me. But this was certainly one of those things. And the other thing, which I think took me a lot longer to internalize, was that there was nothing fundamentally right or wrong in investing. It is a highly complex, markets are highly complex. And therefore, we operate in a midst of a huge amount of uncertainty, right? There are close to, for all practical purposes, infinite factors that go into a success or failure of an investment. And the trick, I think, is to figure out what are out of all these things that could matter, what are the five things, the three things that are the most important on one hand, right? So trying to prioritize rather than try to get everything right is important. And the other thing is, again, there's no right or wrong. We live in a probabilistic world. By definition, the outcomes are uncertain. And therefore, it's less about trying to be right and more about trying to, at least in the context of growth investing, which is what we were doing, was trying to be not wrong. And then how many sort of margins of error can we build into our thought process, right? And that brings you back to the more modeling and technical part of it, which is I realize that this is not about a truth on an Excel spreadsheet, but it is about scenario analysis, right? What we're trying to do is just map out possible outcomes based on what we think are the most critical factors, right? So that sort of mindset, I think, was super important, and has become even more important as I sort of moved forward in my career.
Yeah, so as you said, leading on from that, you mentioned at the start of your career coming in with the limited commercial and technical background. Could you share some early decisions or investments you were a part of that didn't go to plan,
Sure.
and what you felt the real costs of being wrong at that stage?
Sure. So look, I'll pick the first investment that I worked on when I actually came into private equity. Since I was quite junior, obviously, the decision to invest wasn't sort of mine. In fact, I came in a little bit halfway through it, so the decision had been made, right? But obviously, based on everything, the conversation, etc., I was reasonably convinced that the plan that we had, the projections that we had, made sense, and this was a fantastic investment and so on. And then once that was closed, very soon after I came in, I was actually thrown into the portfolio management role. So I was sitting there on site. It was the aviation business, in a small emerging market country in the region, and I think that's when sort of the reality of what a business is sort of hits you, right? And all the sort of simplistic assumptions, high level assumptions that were made in the beginning on what we could do in terms of expanding capacity, what we could do in terms of improving efficiency, all of that looked great on paper. And and not to say simplistic in the sense that there was a lot of work done into it. There's a lot of detail into all these plans. We got in global consultants to sort of advise on, where does this operation sort of lack in terms of best practice, and then what needs to be done to fix it. But the actual doing of it, right? And these are things that we have to be, and the things that I learned later. But the things, there's this whole idea, especially when we go into emerging markets, that they're low hanging fruit, that somehow these markets, these people, don't know what best in class is. They've not seen the most sophisticated global operators. We can bring in the consultants and tell them what to do, and then everything will sort of go according to plan. And the reality is, I think you have to have a lot more respect when you go into these markets for the status quo, right? Often there's a good reason why these fruits are low hanging, right? It's not that necessarily the people don't know what they're doing, but there's just massive amount of circumstantial, structural issues around, why things can't get done a certain way. And so this idea that you can just take best practice from another market because they're just bigger and more sophisticated and so on, and then plug it into a emerging market, smaller player is, I think, a deeply flawed idea. And so a lot more time has to be spent on understanding why are things a certain way, and then trying to figure out, okay, are there a few of these things? And it's not going to be everything. Are there a few of these things that we can actually change, right? And then the question is, okay, fine. If these are things that we can actually change, who's going to do it, right? Because again, consultants will not get the job done. So you need people. And if the answer to that, who's going to do it, is either a consultant going to do it or we're going to do it as investment managers, that's usually a very, very wrong answer, right? So so these were a lot of things. And so obviously what happened was it didn't go according to plan. What we thought were the low hanging fruits in terms of growth and efficiency didn't play out as quickly as we wanted. In fact, it took a lot longer. And so there was a lot of introspection, right? Like, you sort of have this whole idea, this first deal. So you go in there thinking, okay, great, I'm working with really smart guys and smart people can do anything. And I think when the rubber meets the road, you start to realize that there are certain ground realities just that can't be changed. So how do you figure out the ones that can? And so now I spend a lot more time on understanding all the things that are not right, but then trying to really figure out what are the things that can actually be changed and who are the people who are going to actually do it. And hopefully the answer is it's not me who's going to do it, but we have the right people or the right person to be able to lead that process. So early reactions, a lot of sort of negativity. You start questioning whether anything about anything and so on. And I think slowly over time you start to learn how to figure these things out that I said, and then that's when I think things start to work.
It's very interesting. And in terms of figuring things out, I think, you talked about how when rubber meets the road, it's, you might have a set of expectations, but reality, as you said before as well, there are infinite things that can happen in an investment decision, and infinite things that can happen when you're actually managing that investment. So one thing that you could have, at least I'm assuming, is a good mentor. So did you have any good mentors at that stage of your career, or any senior figure who played a very meaningful role in, I guess, shaping your understanding of investing at that point?
Yeah. Look, I think this is a really important point. I think if you can find a mentor, it is the most valuable thing in the world, right? Having said that, that's not an easy thing to do, right? Finding a mentor is hard. One, because in my opinion, investing is an extremely hard thing to do. And there aren't actually that many great investors, fundamentally great investors, right? There could be circumstantially great investors, but fundamentally someone who has some sort of an inherent internalized understanding of what works and what doesn't. Not easy to find. So it's a very small group of people. Not everyone will find a mentor. That's just a fact of life. I think in retrospect, looking back, I don't think I have that which is a mentor who can just take you from 0 to 100 in a relatively accelerated learning way. Having said that, I had a number of senior figures in my career, especially early on, who were extremely helpful. Right. Like I said, my first boss, the one who interviewed me, very smart guy, deeply helpful in helping me learn and get up to speed. I had another, ex-Lehman banker who had come in and joined our team early in the days, who was deeply helpful on the technical side. Right. So there were many people like that who helped me sort of get up this sort of steep learning curve. And then there were also people, the leader of our firm, for example, who, they were building incredible things, and so just watching that close up was extremely useful, right? Both the good things and also the bad things, right? Things that didn't work. And again, I would say that you have to be very careful about because for me, when I was early in my career, I was very clear that these were the things that worked, these were the things that didn't work, right? And these were the things that were wrong organizationally or management style wise, etc. And I think it took me a long time, and actually more recently now, when I set up my own firm, to understand, why certain things, like, it's never going to be perfect. There's always going to be issues. There's always going to be mistakes. And so, it takes some time to sort of go back and rethink that. But that experience of just watching all this close up, we were a small team. We were growing from zero. We went from being a 40 million AUM business when I joined to being, within 4 years, we were about 5 billion. And then within another 5-6 years, it was about 12 or 14 billion of. So just watching that process up close and personal was a massive sort of learning experience. And then later on, I would say in the second half of my career, a lot of that learning has come from just reading, listening to great investors who are, there are maybe 1% or 2% of global investors that would fall in that category. But I think we're so lucky to live in a world where we actually have incredible access to what a lot of these people think. I mean, just podcasts, for example, right? It's just this incredible resource where you have some of the smartest people in the world sitting and having conversations for hours. There's, again, incredible amount of content available out there for people who are interested to listen and learn and so on. So I think that's super important. And I think the second part of my career was driven a lot by sort of trying to understand what these people had done and what circumstances they had done, what made them succeed, and where. And again, a lot of these people are actually very honest about their failures and so on, which is incredibly useful. But at the end of the day, there is no better learning mechanism than actually doing. When you do, the more you do, the probabilities of failure also go up, because again, the reality is in investing, you will fail more often than you will succeed. The trick is to make the successes bigger and the failures smaller, right? But there's no substitute for that. And so again, if I were to map out my learning curve over the last, it's been now 22 years, I think the last 4 years have taught me more than I had learned in the 18 years before that. And a lot of that has to do with the fact that it's not just that I'm doing the deals myself, it's that you're responsible for everything. Anything that goes right and wrong ultimately comes down to you. And that's a incredibly differentiated sort of experience. And I think that has taught me a lot more than I necessarily learned from people or from listening to people or doing the stuff I was doing before without having that burden of ultimate responsibility.
On that theme of learning, as your career progressed, you began investing across multiple emerging markets. What things did you start to notice technically?
Sorry, Harry, I'm not able to hear you for the last 10 or 15 seconds.
Okay. Yeah, so on that
Yeah,
theme
that's
of
great.
learning,
Thank you.
okay. Yeah, on that theme of learning, you began investing across multiple emerging market geographies. What things did you start to pick up on, from technical aspects to managing relationship side of things, of how those different geographies actually operate in practice?
Yeah. So look, yeah. So my career, I've invested across, I think, 20 markets, right? All of them are emerging markets. And that's, the good thing is, every day you're going into a new market, it's an incredible learning experience. And, that's phenomenal in terms of what you get to see. I think my conclusion was that every market is very, very different, right? So there are two tendencies I think that we had. One was, you have this assumption, like I said before, which is you're going into an emerging market and you just think you sort of maybe know better because you have seen things in more sophisticated markets. And I think that can be a dangerous thing, right? Again, you need to have a lot of respect for the status quo. There are very smart people operating in these markets. There's always a reason for why things are the way they are, right? And so you have to be really, really careful on what you think is, because we're always looking for that change, right? We're looking for, okay, how do we change X so that we can deliver all this value? And you have to be really, really careful about trying to pick what it is that you think will change, right? So just having a lot of respect for why things are the way they are and recognizing that there are big forces at play, social forces, cultural forces, political forces, economic forces. And I think the starting point of being successful is being able to evaluate those big forces and say, okay, you know what? Is this a game that I want to play or not play? Right. So market selection becomes extremely important. And that's one of the reasons why after all of that, I sort of decided India was the market that I wanted to focus on because, there's just so much that can go wrong, especially when you're in early stage of development. Resources are constrained, systems are complex and underdeveloped. So picking the right game, picking the right market becomes super critical, right? So that I think that was sort of the biggest learning for me. One of the, and I'll give you a few examples, right? When I started investing in India in 2010, we were doing mid-market private equity. And India always had potential, right? There was never a question on the potential of the market. And we saw great businesses, we saw great entrepreneurs. I think the biggest question mark for us, which we had no answer to, was okay, great, we can do this, we can invest in these companies, and if we are disciplined and good and whatever, we probably make more right than wrong investments. The big systemic question was, how do we sell this stuff? Right? Because the public markets are relatively shallower. There was no secondary market for private equity. So there were a lot of structural issues, question marks, right? And then that's a risk we took, and it worked out, right? Our India portfolio exited at 3.5x, but it worked out because the market sort of moved. It became more mature very fast. It deepened very fast, right? That didn't happen across the board. There were many markets that didn't go in that direction, and we had a lot of issues. One of the biggest, let's just take an example, right? One of the biggest issues in emerging markets is currency, right? And there's nothing you can do as an investor. If the currency goes against you in a big way, no matter how great the investment, it destroys all that value that you've created because of that, right? So examples like Egypt, for example, right? Or Turkey, where Turkey is a great example, great market, phenomenal businesses, phenomenal entrepreneurs. And yet dollar investors haven't done necessarily extremely well there for multiple reasons, but one of the big reasons was currency, right? So there are so many of these structural issues that you just need to be aware of, and then be very, very clear on what putting yourself in the right stream and making sure that there's so many multiple tailwinds that even if one thing goes wrong or two things go wrong, you're still in a game that's still growing, and that's the only way that you're going to have a shot. After that is all the stuff that you do, all the analysis, all the picking and all of that, right? But before that, it comes to that sort of market. And if it's not right, there's nothing you can do about it.
That's very interesting. And I think one phase of, I guess, the business that gets even more complex is when you've invested in the business and now you want to scale it. So then you want to sort of identify what factors are important to scale it. And I think one of the biggest ones there is founders and management teams.
Yeah.
Ultimately, going to put that forward. So I want to focus a little more in India here, but what differences have you seen between founders and management teams when it sort of comes to scaling effectively and then, well, not scaling effectively and struggling when they want to scale the business?
Yeah, look, I think a great question. So in terms of founders specifically, there's a temptation to sort of pattern recognize like certain personality types that are really, or certain attributes that are. What I found is that actually there are a lot of ways to get to success. There is no one right answer to that, right? And so the idea is you need to evaluate something that's much more fundamental. So for me, the things that I think are super fundamental are, one, there just needs to be an incredible amount of energy, drive, obsession, right? Founders who are just obsessed with the thing that they're doing is the fundamental bedrock of trying to be successful, especially in earlier stage businesses, right? Because just so many things have to happen. High growth is extremely difficult to achieve, and then even more difficult to manage, right? So that's that drive, that obsession, that energy, and what that usually leads to is just incredible amount of focus, right? These are people who are only focused on their one thing at the expense of everything else. And people can argue about quality of life, etc. But the reality is you need that if you want to have a higher probability of success, right? So that's just absolutely critical. The other thing is assuming you have that, it's resilience, right? Again, thousands of things will go wrong. In fact, if things don't go wrong, it's just something is wrong, right? So there will be there'll be crisis day to day, existential much of the times in the earlier stages of businesses. So the ability for founders to take hits and keep going, right? And then it loops back into that conviction, drive, focus part, right? So the ability to just, and then so if I can see founders, and I feel like I'm lucky in the sense that because we go into growth stage businesses and not necessarily super early stage businesses, most of our founder, they have had either just on that business a track record of a few years, or sometimes they're second time founders or third time founders, and therefore you have a history. What I'm looking for is a history of actually things going wrong. What went wrong? How do they deal with it? And if you can get, and these are soft things, these are not easy to evaluate, but if you can find businesses where there have been massive issues and they have navigated those massive issues and come out stronger than they went in, that's a huge green flag, right? That's like, okay, fine, that's high conviction there. Not always easy to do, but if you can find it, and I'll give you an example, right? We recently invested in a travel tech business, and obviously at a relatively early stage of this business, we went into COVID. Now, this is an existential moment for these guys, and they did a lot of things, but the reality was 2 years post-COVID, they were 3 times bigger than they were as they went in. They went to almost zero, right? Their ability to manage costs, right? They made some really hard decisions on cutting back on different types of business, and they did it quickly, right? That the ability to make decisive decisions fast in the time of crisis. So we were lucky here because we had this moment, we had the ability to evaluate it, like subjectively and objectively in terms of the numbers that they had delivered. And I think that's, if you can find that in any deal you're assessing, that's hugely valuable. And then the last thing I would say, and maybe equally important, maybe more important, is that founders have to be incredibly good at managing people, right? So you're looking for founders who have the ability to make really smart people do work for them, right? Whether they deserve that or not. And most often they don't, because founders at a very early stage of their careers, often you don't find people who you would say, oh, you know what, this guy, I'm gonna, follow him, right? So that challenge of making people, smarter people, older people, more experienced people work for you, right, is incredibly important. And then the ability to, if you're extremely successful as a founder, you have to manage ego, right? There's a tendency, it's human, to sort of attribute a lot of that success to yourself. The ability to let people do their thing and only step in when needed, right, is super critical. So, that's again, it's a soft thing. It's not easy to evaluate, right? I did an investment in Zepto. The founder was 18 years old, two founders, right? So how do you evaluate that? But, we spent a reasonable amount of time. And I think, apart from the dealing with crisis bit, which I didn't have any data points on, but on the obsession and focus part, and on the ability to build teams, to attract talent, and to manage that talent effectively for an 18, 19-year-old kids, who are hiring 30, 40-year-old veterans of their industry, often at the top of their game. I think that was the hardest thing that they did. And that was, I think, a huge sort of green flag for us.
It's very fascinating. And Zepto is obviously a very good case study, I think, because you have, as you mentioned, you have Adit and Kai, who are two 18, 19-year-old kids going to Stanford and then dropping out to start this business. And then you mentioned I guess we can call it a pivot, focusing and obsessing on the Kirana business and then making mistakes there and then eventually coming to quick commerce and finding a big gap there. It's very interesting. And I believe you were an early investor in Zepto before. I think a lot of the market, as I guess, priced them correctly, or you can say is giving them the credit they deserve now. Could you sort of share that story and what sort of, I guess, other than just the founder fit, which I think definitely exists, what sort of give you the conviction to back them?
Yep. So look, we came into Zepto probably around a year after it was founded, right? So relatively early. But by this time, Zepto was already a Series D business, right? So they had raised a few $100 million. And there were things that were obviously working, right? It was growing extremely fast. Month-on-month growth was triple digit, right? So I think that was obvious, and everyone saw it. And when they started in 2021, which was, everyone was euphoric about all these consumer businesses all over the world. By the time we invested, and this, I think, we got a little bit lucky in a sense with timing, which was by the time we invested, markets had turned late 21 in the US, and they are starting to turn everywhere in the world. And the conventional wisdom became that these businesses can grow, but they can't be profitable, right? That this growth was acquired, et cetera, et cetera. And I think the hard thing that we had to do was sort of take that counter narrative, right? And the reason we were able to do that is because the founder was incredibly transparent. Like they gave us, often I find when I'm talking to founders that it's a sort of a pull process. Like you ask them 10 questions, they give you some information, and then you ask them more. You gotta sort of, sort of almost extract the information that you want. What we found with them was that they were just very sort of upfront and generous with information without going through this multiple iterations of diligence, etc. And they were extremely structured in the way that they presented it, in the sense that they were like, look, we think this is why our business is good. And by the way, here is all the data that will show you that this is true, right? And that was incredibly helpful from our perspective. But generally, the market, look, many people talk to them. A few of their early investors obviously continued to believe in them because they had gone and they had seen this from the ground up. But a lot of the growth stage investors who were looking at the deal at that point in mid 22 were sort of convinced with the global narrative, which is, yes, great growth, but will never be profitable, right? And I think what we were able to do, one, because of the way that the founders were open with us in terms of all their data, but also I think we sort of evaluated some of the key sort of what I call now myths, but at that time, which was sort of conventional wisdom about the business model, right? And we were like, okay, our view is that actually this will work. The market thinks it will not. So let's go through it systematically and see what are the big things that they say are the reasons for it not working, right? And so we went through that systematically, and we had, in our view, enough data to be able to convince ourselves to a high degree of conviction, because it became our biggest deal by far, highly concentrated at that time. I know a lot of people would tell you that that's just a huge mistake. To put so much of your capital into one transaction. But we just felt that given the situation and our high conviction, it just made a lot of sense. We got access at a reasonable scale for, we were a no-name sort of investor, right? We had just started. So there was no reason in a normal scenario for us to be able to get into this deal and get the kind of capital that we put into this deal. And obviously the valuations were reasonable in our mind. And so it was a special situation in a way, right? But that's exactly our strategy. We look for these sort of situations. We look for where consensus can be wrong. And I would say, by the way, 90% of the time, consensus is not wrong, right? So that the trick is to find that 10% or 5% when it is. But if you can, it's a massively valuable thing, because that's where you make alpha, right? If everyone's convinced, it might still work out to be a good deal, but it's never going to make you outsized returns, right? So that was it. I mean, there's obviously a lot of detail, and if we have time, I'm happy to chat through some of those. But I think that was the fundamental sort of situation that allowed us to do that deal. And now I think that people are sort of convinced, or not a lot of people are convinced, not everybody, right? And that's good, because price always climbs over all of worry, right? If everyone's convinced, then you probably peaked. The market is now rewarding these business models quite effectively, and frankly, we're on our exit cycle, so that's a great situation to have.
So definitely, let's say that Zepto is a deal that you're particularly proud of, but also across your career, there are other investments you're particularly good about, not just because of higher returns from the exit side, but also confirming of thought about backing and building the business.
Yeah. Look, I think, luckily, I think for me, most of my investments have actually done reasonably well. There have been a few, as I mentioned, where we had issues. But one of my favorites, and there could be different reasons why this is the case. One of my favorites was when we made an investment into an education business in the UAE called GEMS, right? When I remember when we looked at it, I was convinced that this is probably one of the best businesses I'd ever seen in the region at that time, right? And there were lots of issues as well, right? But when you see something, you spend time on it, and you have this deep conviction that this business, is just brilliant. And then to see it play out over not just our investment cycle, which was about 4 or 5 years, but then it's been invested in multiple times with major private equity funds. Blackstone came in, and then CVC came in, and now Brookfield is in the same deal, right? To see that business sort of thrive over a 20-year period, I think that's special, right? And in that interim, again, we had the Dubai 2008 crisis, which was, existential for this city, I think, at that point in time. And this business sort of pulled through with flying colors. And then we had the COVID crisis where everything was shut down, and it still took all those hits. It sort of verifies your original thesis 20 years out. That's I think quite special.
So you had many up and down experiences that led you to where you are today. But at what point did it become clear to you that you wanted to build your own platform? And yeah, what ultimately led you to found Razor Capital?
Yeah. So I think the reality is I wanted to do this a long time ago. I mean, at least 10 years, maybe more. Right. And I actually tried once before as well, and it didn't work. But the reason was, my main motivation was that, at some point as an investor, you got to have a view, right? You have a thesis, you think, you understand how it works, and you need to test it out. And what happened for me during my professional career, which I was working for other people, was that I realized I was spending actually a huge amount of my time trying to convince a person or a committee of of doing something, right? And the problem with investing is that by definition, you're going into the unknown, right? You're taking risk by definition. And there's a tendency, especially as organizations grow and become more structured, with et cetera, there's a tendency to sort of, everyone wants to cover all your bases. There's a risk aversion, right? You need to somehow perfectly justify every aspect of it. And often you can't, right? That's the whole point of it. And so what I was doing was spending a huge amount of my time and effort trying to convince other people to do something, and kind of and I just found that there's a good balance there, right? I think trying to convince people is important because it forces you to test your own thesis and theories, etc. But ultimately, I just found that I was not doing a lot of things that I thought were right because I could not get someone else to do it. And often it was not only a matter of judgment, right? Obviously, people can have different judgments on things, but it was a matter of there were structural issues, right? Priorities for the firm vis-a-vis markets, right? They don't want to allocate more to this market or that market, or there can be personal biases against a certain type of investing or a certain type of company or a certain category of business sector, etc. So that motivation just kept growing over time, right? And so there was a point in time when I was like, when things sort of in some ways slowed down, we had the COVID sort of shutdowns, etc. And, that sort of started to make me think that, okay, now as we came out of it, maybe this was the time. If not now, then when, right? So that's was really the motivation for me to set up Raisin.
It's very nice how you describe sort of going from that very committee and consensus-based decision to now sort of being in the position yourself to make those decisions. And it makes you think that if you have people coming to you with their own theses, how you sort of deal with them, and you sort of compare that to would have my bosses been the same way. So I think it's very interesting that you describe that, which is leading into the next question about the investment process at Razor, and how do you sort of view? Is it more of a science to you, because you mentioned theses, but also is there also an art aspect to it?
Yeah. So I think it's not a science for sure, right? But it can be systematic, right? And so I don't describe our investment style as thesis driven, right? Because my fundamental view is that the best people to figure out how to solve a difficult problem, because that's what we're looking for, right? We're looking for people who can figure out how to solve a difficult problem. Because if you can solve a difficult problem, that's where you get that sort of outlier growth, et cetera, right? So the best people to figure out how to solve a difficult problem are the entrepreneurs, right? They are better at it than I will ever be, right? So you have to be very clear about recognizing that. And therefore, what we like to do is we like to have principles, right? There are certain principles along which we want to operate. And those principles we intentionally keep extremely high level, right? Because the minute you get more and more granular, you're starting to create, sort of artificial constraints that, in my view, are not necessarily driven by data or driven by ground realities, right? They're driven by your perception of certain things. And my view is fundamentally that I cannot have the right perception because I'm not the person closest to the ground, right? I think where we are very good, I like to think, is actually recognizing it when we see it, right? So if we if we see a business model, if we see a entrepreneur who is solving something hard, I think what we're good at doing is recognizing talent or recognizing opportunity when we see it. But I don't think we're as good as figuring out before it has happened, right? So a lot of people say, I will do, I like this business model. Let's say, right now, wealth tech is really hot in India. I love wealth tech because the macro numbers are phenomenal. Great. But my point is that if I have figured it out, so have everybody else, right? So I'm not going in early on this. What I need to do is keep my mind open, have a certain set of principles that I want to operate under, and then be open to seeing, what the entrepreneur is saying, right? And then the only thing I need to do is make a judgment call on whether that makes sense to me or it doesn't make sense. It's not about right and wrong. Again, it's just, there'll be many things we look at that we will pass on that will end up being great, right? But that's okay, right? In the business we operate in, unlike in venture, for example, the omission is not my biggest risk, right? Doing something wrong is probably my bigger risk. So I'm okay with missing out on good things as long as the things I do work, right? So that's how we try to operate our investment process. So keep it actually very open. We're completely opportunistic when it comes to sectors or business models. We have certain sort of criteria that we want to see at a more generic level, right? We want to see, potentially large markets if you can solve a certain thing, right? So quick commerce is a great example. Grocery in India has always been a very large market, but again, for the longest time, organized grocery reached a plateau. The big box models got to about 7-8% penetration and then stopped because the assumption was, and the reality at that time was that the unorganized sector, which was the kirana sector and grocery, had some overwhelming structural advantages, and you just couldn't beat them at that game, right? And then suddenly you have this quick commerce model comes along, and actually all the attributes of it tell me that actually they would beat that incumbent 94% market share unorganized category, and that's beautiful. But then again, multiple people have tried it, and even when we were investing, there were at least 2 or 3 that were not doing extremely. In fact, they were failing, right? So, but I think what we recognize is that these guys, with the sort of specific take on the model that they had, plus their execution capabilities, plus the founder mindset, was something that had a shot at winning in a very potentially large market if they could solve these problems. And our view was they would solve these problems, right?
So India has become a central focus to your investing platform. What has kept you committed to the market across the long term? And have there been particular sectors or themes that you've spent the most time on, and what really drives that focus?
Yeah. So like I said, I think for me, market selection, and at every level this is true, right? But market selection is super critical, because if you get the market wrong, no matter how good you are, you're sort of operating across, you're outperforming, but you can outperform across that sort of trend layer. So market selection is important. I think India checks a lot of boxes, right? Our entire sort of philosophy is based on long-term secular trends. We are not short-term investors, we're long-term investors. So we're not looking for cyclical trends. It checks a lot of boxes on the secular growth trend, right? Whether it's on overall GDP growth, whether it's on digital growth within that, which is a multiplier of overall GDP growth, right? And then other things around it, right? They support infrastructure when it comes to regulation, right? And what we're seeing, again, long-term trends, right? When it comes to markets, public markets especially, because public markets are critical for exits, right? And till 5 years ago, frankly, nobody had an answer for exit. And now all of that has changed, right? But again, our view is that the public market has cyclicality, but liquidity in Indian public markets is a secular trend, right? So we want to see multiple of these secular sort of trends that will support, right? Any investment thesis that we have within it. And India checks those boxes for us. Plus, it has the right scale and depth, right? If we're going to run a highly selective investment funnel, right, we look at hundreds of companies and we do 2 a year, right? That's how we operate. We just need a large playing field, right? So we could look at other fast-growing emerging markets, but they're smaller, which means by definition, you just have a lot less to pick from, and simple probabilities, right? When you have a bigger set, you have a shot at picking outliers, right? Now, whether you're good at that or bad at that, that's a second thing. But at least, the probabilities of more number of outliers is much higher. And so that all of those things, I think, was super important for us when we decided to sort of focus exclusively on India. Within that context, my overall view is, honestly, there's opportunity across almost every category, whether it's a sector, whether it's an asset class. So, I think there are opportunities in private credit, in real estate, in infrastructure, in public market, which again, great, right? You want to see markets like that. Even within any of those, whether like private equity or venture, there are opportunities across consumer, across SaaS, now across potentially AI, deep tech, manufacturing. You've got to figure out where, so opportunities are plenty. You got to figure out where your skill set, your whatever your competitive advantage might be, will allow you an edge, right? And so that's what we're trying to do. We're trying to say, okay, fine, we think India is great macro. We think India digital is an even bigger story, right? We think all the supporting infrastructure is in place. But within that, obviously, it's a competitive space, right? So where do we want to operate? So where we thought there were gaps in the market was in stage, right? So we felt that the liquidity in private markets in India was more concentrated, sort of a barbell, right? You had a lot of liquidity in early stage and you had a lot of liquidity in late stage. I think where there was relatively low liquidity was in the sort of mid-growth stage, right? So that we picked on that. And we felt that there were some structural gaps, right? So for example, secondary investing has become sort of core in markets like the US, et cetera, which are more mature. Secondary investing in India is still relatively nascent because, the ecosystem is younger. So are there as many specialist funds that are focused on stage and secondary, right? And the answer to both of those independently is no. The answer to both of them combined is even better, right? So what we tried to do was we identified these gaps, and then we layered on top of that our sort of style of investing, which is we are value investors in high growth tech. That was another space where generally we found, it's not universally true, but generally we found that tech investors are relatively value insensitive, right? They tend to focus, because most of them come from the venture world, they tend to focus a little bit more, index heavily on growth and people, which is, in my view, completely reasonable when you're doing venture. As you go to growth, I think that becomes less important. I think things like value, profitability, capital efficiency, all of these, speed to exit, all of these things become, if not equally valuable, maybe more valuable, right? So these were the ways that we try to create differentiation. These were the ways we sort of structured our strategy, with the ultimate objective being we want to build something that is a high absolute performer. We want to be a top 5% fund in India, right? That's what we want to be. And so that was how we sort of thought about opportunity in India, rather than thinking about it as a sector or as a specific theme. The luxury we have, in my view, is that actually there are so many themes that can work. So pick the place that you fit the best, where you feel there is relative competitive advantage.
If we also talk about tech again, you mentioned sort of a very interesting balance, I think, between being a value investor, trying to find undervalued businesses within a sector that is known for having astronomical, at times, valuations. It's not easy. And you've also, I think, on the side of Razor Capital, you've also been involved with Mount Tech Growth Fund.
Yeah, that's right.
Could you sort of tell us more about that? Is that just another way for you to sort of exercise investing in tech and focusing on?
Sure. Yeah. So look, like I said, I think there are so many opportunities in India, right? So you can figure out where you want to play quite effectively. Now, when I think about the sort of a business of private equity or the business of venture, right, the business of alternatives, there aren't many places in which you can find white spaces, right? And also the structure of the business. In private markets, it takes a long time to build credibility, right? Because our investment cycles are longer. And, if someone wants to look at a 3-fund track record, that takes you 15 years minimum. Like there's just very little way to compress that time to credibility. And therefore the barriers to entry are massive, right? The barriers of brand, of track record, etc. So building a new asset manager is hard, right? And so I was very keen to find spaces that were less crowded. Now, my core focus is what I described to you with Razor, right? But there was an opportunity where, I have a close investor who was very keen on this space, and they had some credentials in this space and what we saw was that we were in a sunrise category in India, which was defense, aerospace, let's call them broadly strategic industries, right? It aligned very well with government sort of programs around Atmanirbhar, which is self-reliance, and also in-housing or reshoring a lot of the defense value chain, right? So there was an interesting situation where there is no specialist fund that's doing that, right? there are, again, structural tailwinds that are super interesting, which is government has basically put in place purchasing programs that will force the ultimate customers, whether it's the army or the police force or the border security or whatever, to purchase certain technologies domestically, right? And so that sort of structural situation was extremely interesting. And so that was what we wanted to take advantage of. Now, obviously, by definition, this is a very early stage strategy, right? It is not what Razor does. Razor does more sector agnostic growth. Mount Tech and our fund in that called Kavach is by definition a very early stage deep tech. So it's very different, but it was a opportunity to create a first, which is not easy to do in private markets. And so that's what really got us excited. And we started a couple of years, I think a year and a half ago. And so far it's been doing extremely well, but time will tell, right? It's a bit early to see the end result, but certainly the conditions on the ground were perfect, I think, to set up something new. So that's why we decided to do that.
But it's great to see that you've had such a, I guess, broad career, but also you've had the chance to be so focused on in-depth sectors. And I think that's, one of my key takeaways from this conversation, that you can have a lot of experiences across economies, across markets, and you can still go so deep, and you can only have, I guess you could say, surfaced a certain percent of the market. It's just very complex. With that being said, what has been the most fulfilling part of your career, or even life broadly so far, would you say?
It's a good question. So from a professional perspective, I just love the process of investing. I think, if I had to think about all the things that I do on a daily basis, I think the time I get the most excited is when we sort of discover this incredible opportunity, right? So the ability, look, it's early days, but the ability to do that on your own, to be able to have a view and then test it and then see it work or not work, right? That's incredibly fulfilling. It comes with a massive amount of stress and what have you, right? But that is incredibly fulfilling. And I think we're still in the relatively early part of that journey, but so far I've thoroughly enjoyed it, and I'm just hoping to. Frankly, I'll be very happy to keep doing this for a very long time. Right? Never say ever, but for a very long time.
And as we sort of enter 2026, what kind of problems or opportunities would you say you're most interested in spending your time on next?
So look, I think, like I said, we're so early in our process. Frankly, I'll be spending all my time just building out Razor, right? That's my objective, right? And like I said, our goal is not to be the biggest or even very big. In fact, I think size is in my scale and quality of investments pull naturally in different directions, right? So we're not very focused on scale. We're only focused on scale enough to make, pay the bills so that we can keep doing what we're doing, right? So the focus is on being an outlier performer, right? Can we deliver best in class returns in India, which is an extremely competitive market? And I think if we can do that, that's very special. There are hundreds of GPs, everything established domestic players. So if we're able to outperform there in that market, I think that's going to be a massive accomplishment, and that's what we're focused on, and that's where I'm going to spend the foreseeable future working on. And for now, from a strategy perspective, I think, like I said, I think we've identified niches and opportunities that are large. And so, at least for the next 3 to 5 years, which means this second fund that we're raising and probably another one, I don't see any reason for us to necessarily deviate from our core strategy. But markets are dynamic and they change. And so, we will obviously continuously evaluate to see if that works. And, if they want to do something differently, or, whether that's from a strategy perspective or from a size perspective, et cetera. But for now, I think we are in a very sweet spot. And so the idea is just to, deliver on that performance promise.
Thank you very much for your time today. It's been a privilege to speak to you. Your discussions have brought lots of new insights to our conversations that we've had. So yeah, we're really grateful for your time. Thank you.
No, thank you guys. It was a pleasure. Cheers.